Hey, how's it going, guys? Welcome to the Module 4 of Options Trading Foundation, the complete options trading course for beginners. This will be the last module of this entire beginner course. There will be 4 sub-modules in this Module 4 covering 4 different advanced options trading strategies for complete beginners. In this video, we will start from the sub-module 4.1 and share with you guys one of the most powerful market-neutral strategies called the straddles. Alright, let's get started. So what exactly is a straddle in options trading? A straddle is a delta-neutral strategy that involves simultaneously buying call options and put options on the same underlying stock with the same strike price and the same expiration date. Back in the submodule 1.5, the option Greeks, we mentioned that delta measures the impact of the changes in the underlying stock price. When delta is positive, you will make money when the stock price goes up. When delta is negative, you will make money when the stock price goes down. But when delta is equal to 0 or close to 0, we call it the neutral. Then you can make money regardless of the market directions, as long as the stock price makes a significant move in a certain time frame. So delta neutral strategy means no matter the underlying stock price goes up or down in a certain period of time, your trade will make money in either directions. The only thing you need to make money with a delta neutral strategy is that the stock price has to move. Straddle is one of the most classic delta neutral strategies in options trading. Delta neutral is also called the market neutral. Sometimes you might hear hedge fund managers mention about market neutral strategies. They basically mean the same thing. Your main goal of taking a straddle trade is to profit from a potential significant price movement and volatility spike in the underlying stock, and at the same time minimize your potential risk. The best time to use a straddle is when you anticipate there will be a significant price movement in a stock with a volatility spike in a certain short period of time, but you are not sure which direction this move will eventually head into. Usually, a straddle is perfect for taking advantage of this catalyst news or events before their official announcement. For example, such as those companies' highly anticipated earnings reports, important FDA approvals, new product release, for example, and even those company buyouts, merger and acquisition decisions. These are all the events that could lead to significant price movement to either direction. If such market opportunities are something that you would like to trade on, then the straddle should be on the top of your playbook. Trading such high volatility events can be extremely risky sometimes due to the huge swings on the stock price. A straddle not only can help you maximize your profits in such markets, but also can help you minimize your risk. I will show you guys how exactly you can achieve all this in the case study later in this video. There are 2 trade legs to construct a simple straddle trade. First, you buy one call option with the strike price close to your potential short-term profit target. Then at the same time, you buy one put option on the same stock with exactly the same strike price. So basically, for a straddle trade, you will only buy or long the options. There's no short selling involved. You will have to buy both call and put options on the same stock. Both of them have exactly the same strike price and the same expiration date. The number of calls and puts you buy for your straddles must be exactly the same. So this is how you construct a straddle trade using options. Now let's do a case study and see how exactly you can make money from a straddle with a real example. Apple stock is currently traded at $100 per share in October 2020. Apple's next developer keynote conference will be in 3 months. And in the coming next conference, Apple will announce a completely new categories of products that will potentially replace iPad. As a huge fan of Apple, you know a lot about this company, and you believe that is gonna be a make it or break it announcement for Apple, and their stock price will react significantly after that event. But you are not sure if the market reaction is gonna be positive or negative. You would like to make some quick profits out of these big events, but at the same time, you do not want to expose your portfolio into too much risk. So the best strategy to take advantage of such a situation is to use a straddle, and this is how it works. First, you buy one Apple January 2021 call option at a $105 strike. Currently, this call option is traded at $6.8 per contract. Then you buy one Apple January 2021 put option at exactly the same strike price, which is traded at $9.7 per contract. Now let's do some quick math and see what we can get from this straddle trade. First, you will have an instant net debit of $950 out of your account as the cost when you execute this trade. It is the total sum of the call and the put option premiums combined together. Your total risk is equal to the net debit, which is $950 we just calculated. Your maximum reward is unlimited. There is no cap for what you can earn from straddles. There are 2 break-even prices for a straddle trade, the upper break-even price and the lower break-even price. In this case study, your upper break-even price will be the strike price plus the net debit divided by 100, which is $114.5. And your lower break-even price will be the strike price minus the net debit divided by 100, which is $95.5. Alright, once we have all these numbers, we can now move on to the next extremely important step, draw the risk graph of this straddle trade. So basically, this is how the P&L line looks like for a straddle trade. First, you will have the strike price at $105. Then, you will have the upper break-even price at $114.5 and the lower break-even price at $95.5. So from this risk graph, we can see that if the stop price goes up and stays above the upper break-even price by the expiration, or the stop price goes down and stays below the lower break-even price by the expiration, you will make money from this trade. And there's no limit for your maximum potential profits. On the other hand, if the stop price stays between these two break-even prices, your trade will be in losses. And if the price unfortunately closes exactly on the strike price, your trade will hit the maximum loss, which is $950. So this is how the entire risk graph looks like for this straddle trade. Alright, now let's take a look at the 3 potential scenarios where you can make profits from these straddles. First is when the underlying stop price goes up and close higher than the upper break-even price by the expiration. In this case, your call option will make money, where your put option will expire worthless. The profits from the call option will be enough to cover the initial net debit, so your total profits will be positive. Second scenario is when the price goes down and closes lower than the lower break-even price by the expiration. Then in this case, your put option will make money, while your call option will expire worthless. The profits from your put option will be enough to cover the initial net debit, so your total profits will also be positive. These 2 scenarios are easy to understand because we can directly visualize them in the risk graph. However, there is actually a third scenario where traders can also generate profits from a straddle. It is called the volatility rush, and this is how it works. Sometimes, due to the sudden option volatility spike, both of your call option and put options premiums will temporarily go up. Then in this case, even the underlying stop price hasn't hit your profit target yet, you can just sell both of your call and the put options and take the profits. Of course, whenever we talk about profits, we also need to consider and manage the risk. There are 3 key risks when it comes to using the straddles. First is when the stop price does not make any significant moves and your trade is stuck between the 2 break-even prices. So to deal with such risk, you need to do 2 things. First, you need to study this particular stock's recent historical volatility behavior and calculate its average high vol moves, because this could be extremely helpful when it comes to choosing the right strike price for your straddles. Second, you should never risk more than 1 to 2% on each trade in your portfolio. This is a very common but also very important position sizing rule. The second risk is called the time decay. Both of your call option and the put option will be losing value as time passes. And it gets much worse when the contract is within 30 days to the expiration. So you should close your entire straddle position strictly 30 days before the expiration date if you're a complete beginner. Then the third risk is that you might be overpaying for the options. This is very common. So the solution to manage this risk is to buy those options when the implied volatility is still relatively low. Alright, before we finish today's tutorial on the straddles, I want to share with you guys 2 extremely important trade management tips when it comes to trading straddles as a beginner. The first tip is called the lottery ticket method. If the stop price goes up significantly and you make pretty good profits on your call options, instead of closing the entire straddle position, you can just sell your call options, take the profits, and then leave your put options open until the expiration. This out-of-the-money put option might be a lottery ticket that the stock could suddenly crash before the expiration, and then you will have a chance to make money on this put option as well. The second trade management tip is called the scaling up method. If your entire straddle position has 5 calls and 5 puts, when the stop price goes up and hits your initial price target, instead of cashing out all the 5 calls, you can scale them up and take profits one by one. It can prevent you from taking profits too early, and it works really well when the stock is in a healthy, strong trend. Alright, that will be the end of this module 4.1, the straddles in options trading. In the next video, we'll move on to the sub-module 4.2 and talk about another extremely powerful delta neutral strategy called the butterfly. If you are new to this channel, my name is Vic. I hope you guys enjoying the course so far. If you find my contents have been valuable to you, please consider subscribing. Again, thanks so much for watching guys, and I'll see you guys in the next one. Bye for now.